So you've built a solid nest egg and you're feeling really good about your current portfolio, but one terrible year in the market steps in and changes everything you've worked hard for. The financial dominoes you've carefully lined up suddenly teeter on the edge. A bad year early in retirement can have a much bigger impact than one later on. But there are ways to buffer against this risk, protecting your hard-earned savings when timing turns against you. There are many risks that we face throughout our retirement and really as we accumulate our nest egg for retirement. But today in this video, I really want to focus about 3 major risks that we face with current markets. First one being inflation. We've been facing inflation for the past year and a half as we record this video, and we continue to get quarterly information that inflation is still running pretty hot and we're not taming it exactly the way we want to. So it forces investors potentially to keep up with inflation. And so even though we have a good interest rate environment, being too conservative can ultimately, safely lose you money. So it does require potentially a more aggressive investment approach. This can lead to being potentially over-aggressive, though. So there's this fine line between how we invest, and it starts with making sure that you have a plan in place, which I'll talk to. But the second major risk that we face is sequence of return risk. As I mentioned, a major downturn in the market or a pullback on your investments early on in retirement have a much more significant impact on your future retirement than a downturn later down the road. So sequence of return risk simply states that you may have the perfect nest egg. You've built everything you've wanted to, and you are in a spot where your withdrawal rate is great and you are confident that you can retire. Well, 2008, 2009 type of market hits and you didn't have a plan in place for income needs, and all of a sudden your portfolio takes this major hit, and all of a sudden that golden retirement doesn't look so great anymore. Your withdrawal rate is higher than what is sustainable, and this could have happened first thing in retirement. So you're forced to go back to working potentially, or scaling back on what you're spending, which nobody wants to do when they work their entire life to get to where they're at. So sequence of return risk is a big one, and it starts with it's never too early to start planning for your income that you will need in retirement. The next major risk that we face that generates very volatile markets are changes to government programs. These are things such as Social Security, IRMA, which is an income-related monthly adjustment to your premiums for Medicare. We could have tax brackets in the future that go up, or tax loopholes closed, things of that nature. These are big changes to government programs. But while on government, we are currently in a year where we're faced with a major election, right? And this is where people tend to get a little squirrely, especially with the election that we foresee coming here in 2024. There'll be a lot of media attention. There'll be a lot of fear-driven messages out there that can lead people to make knee-jerk reactions and, again, potentially derail their future retirement if they make the wrong decisions. So really important, these 3 risks that we face, that you are proactive in building a strategy to reduce that emotional decision-making during volatility. So there's many reasons to work with an advisor. I'm not going to go into all of those reasons, but I can tell you the most important one starts with income planning. Not only is income planning the most important, because that's what matters the most to you once you get to retirement, is that you have enough money coming in so that you can live the lifestyle that you want to live. That's pretty simple. But planning for income and knowing that you have I'm going to call it a buffer zone. You have buckets of money where you know where you'll be grabbing your income from in, let's say, the next 18 months or even 3 years, 5 years, to where if the markets decline or go down, it does not impact your spending. You know that you're taking from a conservative or very low risk or even safe bucket of money that allows the rest of your money to be able to have that capacity for risk. You can kind of call it ride the market a little bit, ride that volatility a little bit. Time segmentation, that's another income planning strategy where, again, you're kind of bucketing out, maybe it's 3 or 5 year buckets, starting with something safe on the front side of that, all the way to something a little more on the aggressive growth side on the back end bucket. So you're time segmenting based on when you will need that income. So the next one that we see a lot of individuals like to use from an income planning strategy is more cash flow based. And this is truly drawing a line somewhere down the middle of the assets and separating into what is needed for income throughout retirement versus what can be more geared towards growth and liquidity and legacy at the end of the day. So by putting together one of these income planning strategies, it reduces the stress that comes along with a volatile market and the emotions that come with that, so that you're not making knee-jerk reactions. If you have your income for the next 3 years or 5 years or lifetime taken care of, you're more likely to not react negatively when we see volatility throughout the market. So what I have seen over my time is that behavior such as making knee-jerk reactions and getting too emotional to your investments with the reactions can lead to failure in retirement. I've linked a video here, The Ultimate Guide to Retirement Success, to provide more tools with how to set up the most positive experience you can have in retirement. Thank you, and see you next week.